come into the last quarters of 2023. So it's been a year where it's marked by an uneven recovery. So what can investors learn from the market history in 2022 and also 2023?
Yes, I think 2022 is indeed a very exceptional year in which the correlations between equities and bonds just totally break down. So in the past, investors tend to think that as equities go up, bonds maybe can come down. But when equities come down, you find safety in bonds. But however, 2022 was a time in which interest rates were going up, and that actually caused the drawdowns in equities. So in reality, markets are very dynamic. I think what we need to take the lessons from 2022 is nothing is for certain. Even a free lunch of diversification is not certain. The issue going into 2023 is a little bit more varied. There has been a lot of expectations that because of the losses suffered in 2022, that 2023 can actually, you see a bit of that recovery. Unfortunately, 2023 recovery continues to be uneven because central banks all over the world, they are still fighting inflation, which means interest rates were actually going up higher, and investors have to contend with lower equity prices or in certain markets. So nothing is guaranteed again. I think the history of what 2022 and 2023 tells us that we need to be very nimble and we need to react accordingly to prevailing market conditions.
Yes. Then, what are some of the global trend and key market signal that you're watching out over the short and medium term?
Definitely over the short term, I think one very key thing that we're looking at is the turn in the interest rate cycle. So Federal Reserve has been increasing interest rates for a very long time, from 0% to 5.5%. Now this is where I want to differentiate a little bit from what the market has been expecting 1 year ago, because it seems like the investors were saying at the end of 2022, the Federal Reserve will have to cut interest rates because of a recession in 2023. Now we are in November 2023, that has not happened. I want to differentiate and make a statement to say that in 2022, Federal Reserve already said they are still fighting inflation. They have a lot more rate hikes to go, but markets were already saying that I'm going to call the bluff by the central banks. They cannot raise interest rates. Now the situation is a bit different. Central banks all over the world, including the Federal Reserve, have said that they are more or less done with interest rate hikes. They want to wait and see whether the effects of very aggressive rate hikes is having an impact in the real economy. So because of that, we can more safely say for now, especially with interest rates in very restrictive territory at about 5.5% in the US, that is actually a situation that can break the economy if it is left in this restrictive environment for too long. So therefore, going into 2024, what I'll be looking for is really signs of inflation being more successfully subdued, growth having a bit of a negative impact but still trending and positive, employment numbers starts to come off, and that will be the signal to tell me that the turn in the interest rate cycle is around the corner.